Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Eddie Speed. He has over 40 years of experience in real estate investing and has purchased more than 50,000 real estate notes nationwide. While most investors focus on owning and managing properties, Eddie specializes in the part of real estate the banks care about the most, the payment. Through the note school, Eddie helps everyday people understand a simpler, more predictable way to think about real estate wealth. Eddie, I'm looking forward to our conversation today.
How are you?
I'm good. I love to start with every guest, though, kind of their background, where you grew up, what you did maybe before investing in notes, how you got into the real estate.
Well, I'm guessing if I told you I was from New York City, you wouldn't believe me. I was born and raised in Mississippi, so that's where the Southern accent came from. And I started in the note buying business from my father-in-law in 1980 in Hattiesburg, Mississippi. Now, I live in Dallas-Fort Worth, and I have since 1982, so I'm kind of consider myself a Texan at this point. But that's how I got started, and I just grew up there, middle class. I wasn't, we weren't poor people, we weren't rich people, we were just regular folks. I was a cowboy, like legitimately a cowboy, and thought my life was going to be in the cattle business. And in 1980, if you know, interest rates were outrageous and the market was in very disruptive times. And so my life path changed. And that's what kind of led me to buying notes, because what was really good in 1980 was buying notes.
Yeah. Makes sense with the interest rates. For the audience who's maybe, a lot of folks actually, believe it or not, out there think that the interest rates that we're seeing in today's market are still on the high end, right? Maybe from a perspective standpoint, can you let everybody know kind of what you were seeing in the 80s for rates?
So interest rates in the early 80s, the typical yield that we were buying a note at was, north of 20%.
Wow.
Here's another interesting fact. The average mortgage rate for the past 50 years is 7.7%.
Yeah, which we're below that. So you would think that there would be as much of a slowdown in the market, but
I have a perspective on all that, by the way. I don't think it's all because of rates. I think underwriting has affected that market as much as rates have, and I think that's not commonly said, but I'm just saying if you look at data and you look at like underwriting standards and how tight it is, basically, if 1,000 people could get a loan in the end of 2019, 550 people can get a conventional mortgage today. That's basically how much tighter underwriting is.
Wow. Yeah, that very well could be an attributing factor for sure. It just seems like things have slowed down a little bit. There was obviously we had a huge run there for a little bit as well. throughout kind of post-COVID and even during COVID, people are starting to see, hey, I may be able to work from my house. So maybe I can upgrade. So I've got an office, that kind of thing. So there was a little bit of a pull forward in the, at least in the residential housing market, I think, from some of those things. So you learned about investing in notes through, you said, your father-in-law?
Mm-hmm.
And so what type of note investing was he doing? And, did you adopt the exact same kind of formula? And how has, I guess, that changed over the years since you've been investing?
All right, so if you don't mind, I'm going to back up just a little bit for the audience, and we're going to say
Sure.
investing in notes, and 40% of the people kind of pretty sure they know what I'm talking about, and 60% of the people are like, I don't know what he's talking about. Basically, mortgage loans are traded every day. When you go to the bank and you sign a document and you do a Fannie Mae loan, that loan is going to get traded. It's going to get sold. In fact, everybody that is probably of a certain age and has owned enough houses has all gotten a letter in the mail and said your loan has been sold.
Yes.
You didn't need to approve it. They couldn't change your loan. They just sold your first mortgage on a piece of property to another bank or an insurance company or a hedge fund or whatever. So buying and selling loans is more common than buying and selling houses, actually, because almost every mortgage eventually gets sold. Not 100%, but a very high percent. I buy loans where usually the seller of the property has financed the buyer. And I've made that especially. In fact, I've bought 50,000 such loans. So I buy first mortgages on people's house. Normally they live in it. It's their home. They're paying over time. And I work with real estate investors and help them with a whole kind of formula of how they make their loans before they make them. So I try to have an influence over how people make loans even before they're made. I give them an underwriting standards and structure and all that stuff. That way they make better quality loans, right?
Yeah.
And so I found a niche market that not too many people have ever done excessive volume in, and I've made that my thing. Then I find people that have investable capital. They're a doctor, they're an engineer, they're a retiree, and they, quite honestly, a lot of them have had rent houses, and all of a sudden the bloom's kind of gone off that rose bush because of inflation. And so they're looking for an alternative thing to invest in, and people say, really, I could just be the bank? I don't get 2 o'clock calls with landlords? And so that's what we do is we've created a marketplace. I was just on the phone with a banker that trades $50 billion in mortgages a year. So if somebody came to me with a $25 million portfolio of seller finance notes, I deal at that level product. And as well as somebody has loans, and then we have a school and we put people through kind of a system and a process. Because what they don't lack, they have the ability to buy the loan. They don't have the ability to find it or underwrite it. And we help them with that.
Yeah.
So that's what I've changed that's different than when I started. My father-in-law that got me started in the business, we were just selling loans to institutional investors. We would buy loans, package them up, resell them to institutional investors, and we were kind of the first to market in that, and me being lost. So it's kind of cool. I was young, very green, didn't know much to start. And so I also teach people how to be a young Eddie Speed. How would you go make money finding notes? Because I didn't have any money when I started with my father-in-law. He had the money. He actually had all the knowledge. But I was a good tool because I was willing to have some shoe leather going and finding deals. So I show people how to either be that or people that just want to be crazy passive and they just want to buy a loan and they say, hey, I'm the bank on these deals. I'm not the landlord. Right now, the bank's more profitable than being a landlord.
For sure. And more predictable. I mean, provided the underwriting, like you said, is done correctly in advance. maybe for the audience as well, I'm sure most people understand a first mortgage, a second mortgage, but maybe we can talk a little bit about that and why you've chosen to be in the first position when it comes to mortgage.
So let's just use some easy math. I know most people, the $100,000 houses. Don't try to draw a circle about what that house looks like. Just I'm picking round numbers.
Yeah.
So you have a $100,000 house. Somebody has a first mortgage that's $80,000. It's I'm buying non Fannie Mae type loans, so they're written at a little higher interest rate typically. So maybe say it's 9% interest, maybe it's a little more, maybe it's a little less, but it's a little higher than normal rates, which is normal in the market, right? They're paying that loan out. They signed a 30-year note. But if I'm the buyer of that note, I have a cushion factor because I'm owed $80,000, the property's worth $100,000. You don't have a cushion when you have a rent house. But in this scenario that I drew up, you have a $20,000 cushion in this deal. And so I don't want something bad to happen to the buyer, but I'm not panicking if they do, right?
Yeah.
I'm not wanting bad for them. But it just means I'm in a better position. If your tenant becomes a problem and tears up your rent house, you're going to write the check and fix the problem. Your tenant didn't give you enough security deposit to fix it.
Right.
Right? Or the roof goes bad or whatever. So if you really look at it, it takes a lot less time. The return is better than you're making on rent houses today. Nationwide, the average net income on a rental before you pay the bank is close to 4%. We're selling loans at an average of about 9 to 10. So you're saying you're earning 2.5 times the income being the bank you are a landlord, and it's just a market phenomenon, but it's true.
Yeah. Makes sense. Now, Eddie, are these primarily residential? Is that the main focus, or is it anything? Mm-hmm. Okay.
I mean, I've bought a note on everything you can imagine, and I do buy notes on what we call country land. It's nice country land that people buy. They're going to retire on it, or maybe they're going to, go put a second home on or something like that. So I do buy notes on land, but land and houses is my primary. Over the years, obviously, if I've been doing it for 4.5 decades, I've seen a lot of stuff, but that's the majority of what we see today. And they're houses that people live in. I mean, that's their home. And that's less risky than rental property financing.
Yeah. And you're getting these loans, usually they're originated as a seller finance. So at some point, that seller has decided that they don't want to hold the note. They'd rather capitalize on it and just take the money, all at once. So you have a stream of kind of networks as to finding out who has a seller finance note. How do you find out, that those are out in the market? Obviously, they're out in the market, but how are you finding them?
Well, I've bought 50,000 seller finance notes. There's not anybody with a business card in the business today that says they buy notes that's bought more seller financing than me. So I get a phone call at least once a week with somebody that has a group of loans, right?
Okay.
I'm in several real estate masterminds, including this week. And in next week, I'm in a real estate mastermind with cumulatively the masterminds, call it the top 1,500 house buyers in the business. Yeah. So I'm in the market. I've got that seat at the table, and I have a team that is on the phone, calling, networking, we're using courthouse research. We're doing all the ways to kind of dig those good loans out of the woodwork. And it's work. That's the grinding that my students that I train don't want to go do, quite honestly.
Yeah. No, it makes sense. So networking with those folks. And would it be fair to say that typically somebody that's selling you a note, this may not be the only one they're going to sell you in a lot of cases?
Yeah. I don't target mom and pop customers. I target people that create notes on a recurring basis. So I have a very focused customer that I'm looking for, and it's very relationship based, and so it's just more scalable.
Yeah, no, for sure. Makes a lot of sense, and it also makes spending that time at those real estate masterminds, RIAs, whatever it may be, a lot more valuable. Just because it is typically, you get several folks that are doing this. They're a lot of times they're going in, they're fixing up a property, they're putting a tenant in there, they're advertising that it's going to be an owner carry note so they can get a significant down payment. And it's easier to sell, but you're fixing or you're approaching the market with something that, there may be somebody who's self-employed that makes really good money, but they need 2 years of being self-employed to get the Fannie Freddie type products in a lot of cases. So,
well, I'm gonna say to you that there are so many insanely underserved customers today that have the money and the income to be a homeowner, but they just don't qualify for, what you and I call agency loans.
Right.
They just don't. And we know those customers. We even have a program where we have oversight of realtors. So we find specialist realtors and show them how to find those qualified customers and how to go show. And most of the time, quite honestly, the property being on MLS is not the triggering event for them selling it. They're finding those people even a deeper level than that. So we built a pretty elaborate process where we help them find qualified buyers. We help our customers with oversight of everything they need to create their notes. Now, not every loan I have, we've done all that for, but a real estate investor can come to me today and I have a pretty much complete done-for-you service where he doesn't have to have a back office to create seller financing.
Great. Let's maybe talk a little bit about some of those qualifications. Obviously, and when I say qualifications, the things that you feel like are important to assure that the owner finance note includes to make it marketable, to make it something that would be something you'd be interested in buying.
Well, one of the things that you've already mentioned is down payment. And another thing you mentioned is credit. Okay. So down payment is not an assurance you're going to have a trouble-free loan. That's a myth. Credit is how they've paid other creditors is more likely an indicator of how frequently, how prompt they're going to pay. You're not going to have to go deal with some problem in the future, right?
Yeah.
And there's a lot of people with really good credit, but because they're self-employed, because they earn a commission, because they have alternative income, because they switch jobs, because they can't necessarily source their down payment in some way. There's all kind of stories and circumstances that mean these people are good statistically. And I have 45 years of doing this. Statistically, these people are really good payers, but they don't fit the institutional box.
Yep.
And we're very comfortable with that customer, and we're kind of glad they don't fit that institutional box because we like them.
Right. Yeah. Makes sense. No, that's great. And what about maybe from a investor standpoint, when you're looking at these, and you are maybe a high income earner and looking at other vehicles that you can invest in, why notes? Why do you feel? I know why I like them. You've got something tangible on the other end that is guaranteeing the note. You can see a track record in advance prior to buying them. In most cases, there's at least, however long the original seller held on to them before they end up selling. Like you said, you can look at credit to see how they, how they've done with their other bills. But what are some reasons that you say, this is really something that most people should consider when it comes to their investments?
Well, the two biggest things that people show up at our doorstep that they've previously invested in, they've invested in commercial property syndications, predominantly apartments. And that business has not gone well over the past few years. So a lot of people have lost their money. They've lost part of their money. It wasn't like the promoter said it was going to be, whether it was intentional or just goofy market or whatever it is. They invested in a trouble-free investment, but it caused them trouble. right? The other
Good.
thing is there's 18 million rent houses. But you can find 18 million rent houses, but not a bunch of happy landlords. Because after the virus and inflation, expenses went up 2.5 times more than their rents went up.
Hmm.
So the cash flow of a rental is way less money than it used to be. So it's not as lucrative. They tolerated dealing with tenants and toilets because the house was going to go up in value and it cash flowed and blah, blah, blah. Now, all of a sudden, people are really, really not feeling that way about it. So a lot of people that do something with me have tried some other form of real estate that either in most cases, it's just the market changed on. They didn't really do anything wrong. It's just nothing is constant without change. And so the real estate market has changed. People that are looking for alternatives, I would just say, I never tell people you should take all your money and put it in one asset class. But you probably shouldn't take all your money and put it in the stock market either.
Right.
Right. So it's just an alternative. It does have a proven, there's a risk blueprint that we can evidence that said this is pretty dang good business.
Yeah.
And the other thing about it is it just doesn't keep you up at night. You have it with a loan servicer. You're not dealing with the guy that owes the money. The customer's making his payment to the loan servicer. They're monitoring the taxes and the insurance. They're wiring the money back to you. You're the bank. And you don't get involved in a bunch of day-to-day things. And you don't have to go deal with the IRS. Your loan servicer does that. So it's pretty passive.
Yeah. Yeah, that makes a lot of sense. I'm glad to hear you say that. I was going to ask you, this may sound good for somebody who's looking at purchasing one, but then how about keeping up with the second, the third, the fourth, and having that loan servicer that keeps track of if there's a payoff that's needed. So say the person ends up moving, like traditionally people will over a course of time frame, right? They're going to request at the title company the payoff amount. That's not something you're going to have to go back and start doing all the math to figure out how much they've paid, how much was attributed to interest, how much to principal, and all this can be done through that loan servicer, and they track everything.
One thing that we've done, Keith, is that in our school, everything looks like a funnel, right?
Mm-hmm.
So instead of going and picking people at the very bottom of the funnel, the least people you can serve, who have sophistication and know how to service loans, or they're this or that, and like we try to go up the funnel and say, who's a bigger audience we can serve?
Mm-hmm.
An investor looking for alternatives to traditional real estate, and being the bank turns out to be a very good alternative. They have some money. They want to do it. It's a crazy thing, and we can show people all kind of techniques to go get part of their money back. So yes, you can use leveraging with notes just like you can with rental houses, right? So you can,
Mm-hmm.
so you don't just tie up all your money because you buy 2 deals and now I'm out of money. There's ways you can recapitalize, and we show people those techniques. But we also have figured out along the way, we've got to make it easy for them. And the way you make it easy for them is surround them with a group of vendors that are industry standards, but you surround them with a group of vendors that do things for the client that they really don't want to do for themselves. And that takes you up the funnel to serve more people.
Yeah, love it. No, that's great. Very good point there. Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. No, that's great. Very good point there. And when I would like to hear a little bit, because I haven't heard too much of the recapitalization. Makes sense that there would be that in the marketplace. But what what are some of the baseline rules of thumb there as to how much, if you've got a note worth X amount, how much you can pull back out? And, I'm sure you're paying some type of interest, so they can make a delta on loaning you the money.
Well, there's institutional investors that are in the market that will buy some piece of that loan, right? There's credit facilities where, people can get business lines of credit that even in the marketplace as it is at the moment is still available and still viable. There's all kind of landlords that are looking to put their money into something else. Their wife said, if you buy one more rent house, I'm going to divorce you, so to speak. And so there's more private capital undeployed in the market today than there's been in the history of the United States. Today, right now, the most undeployed private capital in the market. So the market is rich with capital. It's looking for something to invest in. We're just helping narrow people down into how to position it and show people what they've got and why it's a good deal for other people. It's kind of funny. Like I do a fair amount of podcasts, and usually, Keith, at the end of the podcast, after you turn the camera off, and the guy interviewing me goes, "You're really passionate about this," and I'm like, "Yeah, I know. It's a fix for the market." And so you're asking me what percentage of the note? It could be 75% or it could be 95%, depending on the scenario. But you can go get a lot of your money back, and we show people very, that's why they go to school. Like people say, well, give me every detail. No, let's just stay high level of what's possible. And then when somebody gets involved in the school, we show them how it's possible and what the paths you take and what are formulas that you use. We've got all that nailed. But if I knew the possibility that I could buy a note and earn a higher return than a rent house with way less aggravation, and there was leveraging techniques to get my money back, bam. That sounds like a pretty good deal.
Got a little bit of a flywheel going on there. Once you start getting some of that money back, redeploying it, just
that's it.
Rinse and repeat. Nice. Tell us a little bit about the school. How long have you been doing that piece of the puzzle? And, kind of how long is it? Duration? Obviously, they can inquire with you on pricing and that kind of thing. Just whatever you're comfortable going over with the folks.
So I built a school because of a million conversations like you and I just had. Mm-hmm. That's cool. I'd like to do that. How do I do that? Okay. So that was 25 years ago that I perfected a school, either showing people how to create seller financing or showing people how to buy notes, right? Mm-hmm. And it's matured, and you can imagine different market cycles and all the things that we've seen over the past 25 years. So it's changed a lot depending on what was available and what that looked like. But I've really dialed in on what we do now is very timely to the market. The market timing and what we're helping people do right now align very well, right?
Yeah.
And how long is the school? It can be as little as an hour, or it can be a 5-year degree.
Yeah. Okay.
And so we can help people with whatever level they want to take it. And obviously, the further they take it, the more we become extremely confident they're going to really kill it. The one thing that I've done is that when somebody gets to a certain stage in the school is I let them into my marketplace. And once they do that, they don't have to go worry about finding notes, because that makes them fret. How would I go find a good note? Eddie's out there at these masterminds, and he has all these people working, chasing notes. Well, that's a lot of work, Eddie. It is a lot of work. But we then take that note and we find it and we put it through a significant vetting process. It's kind of like the Lexus 77-point checklist for pre-owned cars. It's kind of like that. I'm not stealing their thunder. I'm saying they have use a great example that we kind of think about what we do for notes. We put it through that checklist. In fact, we have a due diligence company that does a lot of that for us, and they are the ultimate technology firm in the mortgage banking world. So we even have a third party that like really takes it under the hood and makes sure it's legal and compliant and all, and they get down to predictability scores. Like how likely is this loan will be successful? So we've really that's all as technology has changed. That's all really, really changed how efficient we can be with the business.
Yeah.
And so now we've got it a lot easier for people to do it than it was in the past.
Makes sense. I'm sure it's going to even get tighter and tighter with AI and some of the different scenarios that can be ran through with that. I mean, they
We're
can
less
look at
than a year away from trading loans on blockchain.
Yeah, yeah, I could see that. That's awesome. When we talk about notes, I guess they're probably all over. But is there a common amount that typically is being financed out there? That's sort of the bread and butter.
Average note's $185,000.
Makes sense.
They're not in the most expensive markets, so they're probably not in California or New York City. But they're in Florida and Georgia and Texas and Kansas and, places like that. I mean, we buy nationwide, but, there's markets that are more common. And these are not unsafe neighborhoods and they're not substandard houses, but they're a house that this is a working class neighborhood. And don't read that into, being judgmental, but I'm just saying they're not executive homes. They're not usually on $1 million houses, although I'm working on one today on a $2 million house in Las Vegas. By the way, you know how much that note cost?
How much?
$800,000.
Really?
Yes, sir.
Wow.
So we see those that are good deals. A real estate operator has it and he needs some liquidity. And so we figure out ways to go find in the market. Our focus is we chase good properties that secure these notes. That is our number one thing. People that live in a good house are way more likely to pay you back. And then obviously credit and pay history and all those things matter. But we don't chase notes secured by substandard properties.
Yeah, makes sense. And that's actually even better than, institutional agency type loans. They cannot discriminate on where and what neighborhood and all that stuff. They've got rules to follow from that standpoint. So you get a little bit more pickiness to be able to actually look and say, hey, am I really buying in a good area?
We're not making a loan. We are buying a note that's already been created.
Yep.
Yeah.
Makes sense.
There's a difference in what, how those laws work. So I appreciate their situation. And once again, we look at our business every day and think, you want to know the best thing about our business and it's not making money? The best thing about our business is we help people with home ownership. We are part of a food chain that helps people with home ownership that otherwise may not get a conventional mortgage, although they pay beautifully and they can pay their bills and they want to pay their bills. And you stop and think about that for a moment, and that's an impact situation.
Yeah, for sure. No, it makes total sense. And it really is. And so what about as far as safeguards in place to assure that they've got the home insured so that you're not, left with it not being backed by the house that you thought it was? That kind of thing.
Just like the guys that had the mortgage on your house or the client's house or the audience's house, right? If you let your insurance not get paid, what's your mortgage company do? What's the loan servicer do? If you let your taxes not get paid or your homeowner association. So there are safeguards in place that servicers do that tell me that I'm not fixing to get wiped out or the house didn't burn down without me knowing it. And so we are very particular about who we approve as a servicer to make sure that we think they have those operations in place and are very competent at it.
Yeah, makes sense. And I figured it was an easy solution. It's just like anything else. But it's just for the audience. I think it's good to kind of point out that. How about from an investment standpoint? When somebody's investing, in a note, are they planning to take this note all the way through the amortization? Obviously, there's going to be folks, group, even if you're planning on doing that, that are going to end up selling, taking you out from that standpoint. But what is the typical time frame on these holds?
So industry statistics say that these loans will pay off in about 7 years.
Okay.
So I don't care if I'm buying a 20-year loan, a 30-year loan, or whatever. What was on Facebook and everybody had a hot sports opinion on 60 days ago, a 50-year loan. I tell people that's irrelevant because people that were making those comments do not understand stats of what we call loan roll-off.
Mm-hmm.
Loan roll-off is a loan that you own that's long-term, but you get paid off prior to the amortization, which is the norm.
Yep.
And about 7 years is the case. So the average loan pays off in about 7 years. Here's an interesting fact. The average loan that we sell to a note school student investor, they get their investment back in about 8 years. They get the entirety of their investment back in about 8 years if they buy a 30-year loan. So it takes them 8 years. And remember, they got their money back every month. So they're not getting it back at the end of 8 years. They are stacking the money and getting it back incrementally over 8 years. The loan pays off in 8 years, then look how much interest they earn because the whole principal pays off.
Yeah.
It's crazy math.
Yeah. Makes a lot of sense. Yeah, even when they're paying off, you're getting away those are amortized. It's interest heavy at the beginning, very interest heavy, especially if it's a 30-year. So as they're making payments, if they do take you out from either a refinance or the sale or whatever it may be, the payoff is still going to be
an 8% mortgage that's 30 years. The principal drops about 10% in the first 10 years. Yeah. So they've paid mostly interest and a little bit of principal.
Yep.
Yeah.
Very nice. Yeah, that's it's an interesting business for sure. How about when folks are looking at, well, let's actually look at it maybe from the investor standpoint. So, on your website or whatever, and of course, we'll give you an opportunity to assure you review all that with the audience as to where they can find what. But if you're an investor out there and you're saying, what Eddie's talking about sounds great. He sounds like an authority when it comes to purchasing mortgage notes, clearly having done over 50,000 of these. He is. I'd like to invest, but I don't want to necessarily invest by myself. Do they have an opportunity to invest through you?
I don't have a fund.
Okay.
I don't want to serve two masters.
I understand.
And so I show people what I found out about funds is this. A lot of people that want to invest through somebody else, the problem becomes you're betting on me.
Yeah.
You're betting on what I say, my management. You're betting on that I know the market. You're betting on all these things. Most people that show up at my doorstep say, I want control.
Yeah.
And so I found out, and I've had a fund in the past for many years, right? But I found out they want control. I can have a very lucrative relationship with them that we both win, where I give them what they want, which is control. When you invest with somebody else, you lose control.
Yeah. Yeah, it makes sense. And so obviously there's that opportunity, right, to invest and put your money in. How about, so you're going to have loan servicers. Is there anything else that you incorporate or have where, as far as a platform or being able to see kind of how everything's performing or going into each individual one? In other words, an aggregate of like how all of the various loans that if you recapitalize and
Sure.
kind of keep this thing moving along.
You're going to have your loans at a servicer that's going to have an online portal where you can go look at a loan or your whole portfolio. right?
Okay, good.
And then we have developed models and templates for people to keep up with their portfolio. So my wife is invested in a whole bunch of notes in various wealth building, retirement accounts, long-term legacy things and stuff. And so we've developed things that allow us to have oversight of the bigger picture. And so we give, people that go down the road with us to a certain stage in our school, we just give them tools that we've already built. They don't have to go figure it out.
Yeah, that makes sense. That's a kind of a neat thing to be able to see how the overall portfolio is doing.
You're going to a school where somebody actively does the business every day. We're not some guru that talks about something we used to do.
Yeah.
And secondly, we've been doing it for 45 years and we've closed a lot of transactions. So it's kind of cool because we already got quite a little filing cabinet built.
Yeah, makes sense. No, that's awesome. And so what are some other things? Are there other advantages to note investing? Is there anything from a tax standpoint that one would need to consider when it comes to this type of an investment?
There is a myth that says there's all these tax advantages with owning properties, but there are no tax advantages with notes. That is a myth.
Okay.
We have stumbled into, over many years, some unique tax advantages you can do with notes. If you have a rental and you seller finance your rental, the IRS lets you pay the gain back over a really long period of time, like over the life of the loan. By the way, what about recapture? Because the IRS says, well, you depreciated and it really didn't go down in value. We want our money back. If you sell it for cash, they want that recapture, which is the depreciation you had taken. They want that back the year you sell it. But long form depreciation, if you sell or finance it, you can also amortize that out over the life of when you're collecting the money back. So there are some terrific tax advantages that most people just don't know about. Their accountant doesn't even know about it because they don't have enough clients that ask them those kind of questions. I'm not saying they couldn't figure it out, but I'm just saying they don't see it enough to be like instantly think about it. And there's some very unique tax hacks that we've stumbled into with notes. I was on a meeting earlier this morning with a tax attorney and a super smart guy that's very seasoned real estate investor as well as a tax attorney. And we're working on things right now that are like kind of cutting edge tax law that says that you can do this. People just don't know how to apply it. So there are some tax hacks with notes that people just wouldn't necessarily know about. The first thing somebody does is they say, I'm interested. Then they start down the road a little bit in our school, and then we actually slow down and show them some real deals, show them what a note looks like, show them what this income we keep referring to looks like. And then all of a sudden they say, okay, well now, Eddie, I want to kind of get really involved in the school. Now I want you to show me what does this look like? What's a risk blueprint look like? How are you confident? How does your wife keep investing your retirement money into notes and she can sleep at night? I mean, there's a reason for that. And that is that we have a very clear risk profile and kind of a blueprint we've built where people go through that process. And then there's okay, well, once again, how can I get part of my money back, or how can I grow it? Or, what's a loan servicer look like? There's some questions that come up as people get to certain stages. Kind of our idea today is we're just trying to say, do you like this idea? Do you like the idea of being the bank? And if you do, then we have a long measurable track record and we can get into very complex answers about things when people get to that point of, hey, I want to know about this. And tax hacks are kind of one of them.
Yeah, makes sense. Yeah, you can't overlook that deal with the capital gains. For those that are hands-on investors that are out there making deals. I mean, one of the better deals I did recently, it was a huge thing for the sellers that they weren't going to have to pay the capital gains by getting it all in one lump sum. And it really helped me to be able to negotiate a better term for me as the buyer as well. And kind of not have to rely on a bank to be able to do it. More favorable terms, less expensive, at the beginning, no points, all kinds of good reasons to do it. But this has been great, Eddie. Want to give the audience an opportunity to find out where they can find out more about you, how they can reach out to you, and then I got a couple other questions for you.
Okay, cool. Well, we want to give your audience kind of a special kind of start, right? And so they'll go to noteschool.com/wealth flow. And so we've built a process there where they can get some better information and figure out what their next steps are. We don't know how interested they are. And the truth of the matter is they probably don't know how interested they are. But we built some sequential steps that they can do, and they can kind of decide like, hey, I really like this. Or it didn't take very long to check it out and figure out they don't like it, right?
Yeah, that's great. We'll put that obviously in the show notes, but wealthschool.com, noteschool.com/wealthflow.
That is it.
All right, perfect. I've got two other questions I ask every guest. One would just be any advice you would give somebody who's maybe just starting out in their investment journey.
Understand risk.
I like it. No, it's good. And how about a book recommendation? Does not have to be real estate or investment related. Certainly can be something you've read that's been impactful.
Everybody in life negotiates every day.
Mm-hmm.
In life, you negotiate. You negotiate with your kids. You negotiate with your employees or your employer. You negotiate every day in some way in functioning in life. And one of the best books that has ever been written about understanding people and how they think is a book that was written by the guy that was the number one hostage negotiator in the United States. His name is Chris Voss. Never Split the Difference. It's a great book.
It is a great book. I used to do a training based around that as well for some sales folks. So, it's a great, definitely a great recommendation there.
Yeah.
Well, Eddie, this has been awesome. I appreciate it. Thank you so much for being a guest on the Wealth Flow, and I think we'll call it a show.
All right. Thank you. I really enjoyed it.
I did too. Thanks. All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.